For most investors, they would be better off being in a low cost index fund, right? That's where you will really create wealth in the long run. Having said that, there are fund houses which could have fund schemes which could be beating the index in the short run, may not beat in the long run, but the question is your choice. People will continue to chase funds and say, oh, this fund has got so much in US, this fund has got so much in this technology, it has got FANG, it is invested in China, so therefore I will beat the index or whatever. But this constant chase for getting a return better than the index will never go away. And most funnily, many people who do stock picking or fund picking don't even measure what they are doing and whether it is doing well for them. Also, we will all continue to chase winners. Like I have been investing in one fund which has given me 87% return in the last 1 year. I continue to be invested in that. I continue to do an SIP in that, knowing fully well that this is not sustainable. The fund manager cannot create this kind of a magic every year. So maybe it makes sense for me to remove some money from there and put into some other fund. But to me, it doesn't matter. I'm going to be in that fund because I like the fund manager's approach of doing it. And therefore, I'm invested. So there's no great logic. But let me tell you what all are the reasons why people lose money while directly picking stocks. One, of course, is by picking some completely lousy company because they feel, oh, market cap is only 500 crores, it will go to 50,000 crores, or it was already at 50,000 crores, it has fallen. Look at 8K Miles, right? It had a market cap of 50,000 crores at some point in time. Today it has come in a new avatar, they've changed their name and things like that. The question is, will you pick up only winners or will you pick up these also rans? Will you lose money there? Picking a lousy stock is, of course, a very, very easy way of losing all the money that you've made in the market. One or two such bad decisions and significant 5%, 7% of your portfolio into that can rip off all the returns which you've got with the other 93% or another 90% of your portfolio. Right? So there are many methods, and so let me start by tabulating some of the methods. One is, if you're a trader and you're paying huge transaction fees, that will rip you apart because your broker will make more money than you will make, and therefore your total returns will go down. If you're an investor, I mean, like I pay a very high brokerage to my friend who is my broker, but I have absolutely no regrets because he's friend, philosopher, guide. We have long discussions, we do research together. He's got people who will do research on something which I specifically ask him for. So there are benefits that I get. So I know what that I pay. I'm paying more than what I would have paid with, say, a Zerodha or even with, say, an HDFC Securities and or ICICI Direct. But I don't mind. I will not go to a zero brokerage account, and I'm not looking at discount brokers. I'm happy with what I have. But yes, paying too much money as an investor or as a trader actually hurts. As an investor, it may not matter much because you pay once in 2 years or once in 3 years. But if you're a trader who deals, who does 4 transactions a day, yes, paying high brokerage can hurt you. And if you do not know what benefit you're getting, like I know I'm paying high brokerage, but I know why I'm paying high brokerage, then it's a different thing. But if you don't know that, that will rip you apart for sure. Also, buying shares with where there is a big spread even today. Market, one thing that the market has done is it has made trading very easy, even though it has made investing very difficult. But when the bid-ask spread is high, don't enter such shares because one day it will just rip you apart. Now, the other way to look at it is to say, it doesn't matter, it doesn't have volumes, but I'm going to sell it after 10-15 years. So, I mean, I have been holding on shares like Rane Madras for a very long period of time, made decent money, but I still know that you choose to be a high bid-ask spread when I bought it, maybe sometime in the early 2000s, right? It always has a high bid, but to me it doesn't matter. I'm not planning to sell it for a long period of time. But if you're a trader, this could hurt really bad, right? Very few scripts today have that kind of bid-ask spread, but it is there. It is not to be ruled out, right? You bought the wrong share, you bought too much quantity, both are wrong. You bought a right share but you didn't buy enough quantity, that's also a problem, right? So not knowing how much weightage to give to which share, or going by a gut, or not rebalancing, this could be another reason why people lose money in equity. Rebalancing is very useful, especially if you are a long only portfolio like most of us are. You don't go short, so you better have a rebalancing, very strict norms, because you don't want one share to become 57% of your portfolio or 72% of your net worth of your family or things like that. And people make that mistake, and then they say, oh, somebody told me that I should never sell the share. Who was it? Your father. When did he say? On his deathbed. I'm sure he had better things to say, but anyway, if he said that on his deathbed, please understand he may not have understood what is going to happen today, right? So remember that maybe 80% of the companies in which your dad could have invested in 1900, or your great grandfather could have invested in 1900, many of them are defunct today. What would you do with those shares, right? So another problem is ignoring the tax implication, because again, I have conflicting things to say. Don't worry about tax if you think the share price has reached its good level for you to sell. And the other one I would say is taxation can take away a big chunk of your trading portfolio. So remember to combine these two. It is not absolute advice saying, oh, ignore tax, or saying worry everything about tax. You need to find a midway path. Right? If something has gone up well in 11 months, you are thinking that, okay, maybe in the 12th month I'll pay lesser tax. The other way to look at it is to take a forward position for selling and hold on to the share, so that in case prices fall, you're making money on the option, and in case the prices go up, you're anyway making money on this, and that is just an insurance premium. You don't know to do all this, be very careful about what you're doing. But yes, you can take a future, first of all, the share has to be in F&O. Not enough shares are in F&O, but if it is in F&O, you can protect your profits by taking a position, right? Another problem which I see among so-called investors is also, or investors or traders, is to have very tight stop losses. May make sense in theory, but practically it means you could lose a lot of money, because it could just touch the stop loss and then rebound. So these are calls which you have to take, and this is one reason why I am seeing people lose money. If you're a big investor and you think you should buy 5-6 lakh shares or 8 lakh shares of a particular company, please look at liquidity. When you are buying, you're the liquidity provider. When you are selling, you could be the only guy who was a buyer, and there's no other buyer. So be very careful in thinly traded scripts. A good chance that you will lose money because you could not sell when you had a strong sell signal, right? One more thing which can hurt you is using too much leverage, which means you're doing F&O positions, or you've taken a bank loan or whatever and you are dealing. So that could also hurt, and hurt very badly. If you're investing abroad, currency movements, we are all assuming that the dollar will always appreciate against the rupee. That may be fine, but you might be better off investing maybe in Japan, because the yen will rise against the dollar. We don't know. So if you're taking cross currency investments, you have to provide in your head at least that there could be a currency fluctuation which you have to. So in a year when US market does badly and the dollar loses value also, you will do very, very badly. In a year when the US market does well, if the currency doesn't do well, some of the gains will be lost. So understanding all this is something which is important. And here also I see people losing money on currency, right? Paying very heavy fees for research, buying expensive research reports is another way to disaster. But yes, people do continue to buy expensive research reports. I think that's about all. I've done many such videos in the past, so just go and see. Could be active trading, could be too much risk, too little risk, not covering your base, not booking profits on the way up, not booking profits on the way down. That could be many. So this was what I thought I could do for today. Thank you.